Before we begin, it's important to state that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation does not constitute financial advice. The strategies discussed are based on extensive research and experience, but you should always consult with a qualified professional to discuss your specific circumstances. Car insurance is a complex product, and your needs are unique. The first car insurance bill I ever received made my stomach drop. It was a single sheet of paper that basically said, "Congratulations on your new car. Now give us a pile of money every month forever." The number on that page was astronomical. Felt like a second car payment. I thought it had to be a mistake. I was a safe driver, I had a normal car, so why was I being punished? I felt completely powerless, like I was being forced to pay a random, non-negotiable tax just for the privilege of driving. And that feeling of being ripped off sent me down a rabbit hole that has since saved me, and thousands of others, a small fortune. What I discovered is that car insurance isn't just expensive. For most people, the system is actively designed to get you to overpay. And the single biggest lie they tell you is that loyalty is rewarded. The truth is, your loyalty is likely costing you hundreds, maybe even thousands of dollars every single year. And in this guide, we are going to fix that. This isn't about finding some cheap, sketchy insurance that won't be there when you need it. This is about understanding the game, learning the rules that the insurance companies don't advertise, and using them to your advantage to get premium coverage at the lowest possible price. We are going to turn you from a price taker into a savvy shopper who has companies competing for your business. By the end of this series, you will have a complete step-by-step blueprint to slash your car insurance bill, and it starts right now in this video. So, why is this so complicated? Why does it feel like your insurance rate is pulled out of thin air? It's because, in a way, it is. Insurance companies use incredibly complex algorithms with over 100 different data points to calculate your premium. It's a black box. They know everything about you, and you know almost nothing about how they decide your price. Think of it like buying an airline ticket. You and the person sitting right next to you on the same plane going to the same destination could have paid wildly different prices. One of you bought your ticket on a Tuesday morning 3 months in advance, the other bought it on a Friday afternoon. One of you used a specific credit card, the other cleared their browser cookies. Insurance is the same but 1,000 times more complex. They look at your zip code, not just the city, but the specific 4-block radius where you park your car at night. They look at your credit score, your marital status, your education level, the exact model, and even the trim level of your car, your driving history, of course, but also how long you've been with your current provider. And that last one is the key. That's the secret trap. It's a phenomenon called price optimization, or what consumer advocates call a loyalty tax. Here's how it works. When you first sign up with an insurer, they often give you a fantastic low introductory rate to get you in the door. You're happy, you set up autopay, and you forget about it. A year goes by and your renewal comes in. The price has crept up a little bit, maybe $5 or $10 a month. You think, well, inflation, I guess, and you let it slide. It's too much of a hassle to shop around for such a small amount. The next year it creeps up again, and again, and again. What's happening behind the scenes is that the insurance company's algorithm is learning about you, sees that you aren't shopping around. It has flagged you as a price inelastic customer. That's a fancy term for someone who is unlikely to leave, even if their price goes up. They know you're loyal. They know you're busy. They know you hate the process of getting quotes. So they slowly, methodically, and quietly raise your rates year after year, squeezing more and more profit out of you, knowing you probably won't notice or won't bother to switch. Meanwhile, they're dangling those super low introductory rates to attract new customers. They are literally using your loyalty-fueled overpayments to subsidize the discounts for new people. They are taxing you for being a good customer. It's one of the most anti-consumer practices in the industry, and it is the single biggest reason why millions of Americans are dramatically overpaying for their car insurance. The moment you understand this one concept, the entire game changes. You realize that the power has been in your hands all along. The key to affordable car insurance is not about being the perfect driver with a perfect record in a perfect car. The key is to break the cycle of loyalty. It's about making the insurance companies believe that you are always one click away from leaving. It's about forcing them to compete for your business not just once, but every single year. So how do we do that? How do we build a system that guarantees you're always getting the best rate? I've broken down the entire process into what I call the 3 pillars of insurance savings. This is the framework we're going to use to deconstruct your policy and rebuild it from the ground up for maximum value. The first pillar is your profile. This is everything about you as a risk. This includes the obvious things like your driving record and the type of car you drive. But it also includes the hidden factors that have a massive impact on your rate, like your credit score, your occupation, and even your homeownership status. Many of these things feel fixed, but they're not. There are dozens of small, strategic adjustments you can make to your personal profile that will make you look like a much safer bet in the eyes of the insurance algorithm, instantly unlocking lower rates without changing how you drive. We will dive deep into how to optimize every single line item of your profile. The second pillar is your policy. This is the nuts and bolts of your actual insurance contract. The coverages, the limits, the deductibles. Most people just accept the default options or say, "Give me the same thing I had before," without understanding what they're actually buying. This is where people waste enormous amounts of money, either by paying for coverage they absolutely do not need, or by being dangerously underinsured in critical areas. We're going to demystify all of it. I'll teach you exactly what liability, collision, comprehensive, and uninsured motorist coverage are, in plain English. And I'll show you how to customize your policy like a pro, finding the perfect balance of protection and price, so you're not paying a penny for anything you don't need. And the third pillar, the most important one, is your provider. This is where we put everything into practice. This is the art and science of shopping. It's not just about getting a few quotes online. It's about knowing when to shop, where to shop, and how to shop. It's about understanding the difference between captive agents, independent agents, and direct-to-consumer websites. It's about learning how to leverage competing offers to negotiate a better deal with your current insurer. This pillar alone, when you master it, will save you more money than anything else. This is how you defeat the loyalty tax and ensure you are never, ever taken for granted again. Over the next parts of this guide, we are going to attack each of these pillars one by one, giving you actionable step-by-step instructions. But for the rest of this video, I want to focus on the absolute foundation. Before you can optimize your profile or your policy, you need to know where you stand right now. The vast majority of drivers have no real idea what's inside their policy. They just know the price they pay. So I'm going to give you a simple 1-minute challenge you can do the second this video is over. It's a diagnostic test that will immediately tell you if you are a prime candidate for huge savings. All you need is your current insurance policy declaration page. Let's get started. Okay, go grab that piece of paper. You can probably pull it up on your phone or computer in about 30 seconds by logging into your insurance company's website. It's usually called the declarations page, or policy declarations. Don't worry if it looks like a bunch of legal jargon and confusing numbers. I promise by the end of this it's going to look like a treasure map. This document is the single most important tool you have. It's the nutritional label for your insurance policy, and most people never even read it. They just pay the bill. Today that ends. Ready? Let's break this down. We're looking for red flags, signs that you are a prime candidate for a much cheaper rate. First, look at the top section. You'll see your name, your address, and the vehicles covered. This sounds basic, but you'd be shocked how often it's wrong. Did you move recently? Even a move across town to a different zip code can dramatically change your rate, for better or for worse. Make sure your address is current. Now look at the vehicle information. It should list the year, make, model, and the 17-digit vehicle identification number, or VIN. Is this correct? Are you being charged for a souped-up sports model when you actually drive the base-level sedan? It happens. This is the easy stuff. If any of this is wrong, you're leaving money on the table. That's red flag number 1. Now let's get to the heart of the map, the section labeled coverages. This is where the insurance companies hide the complexity, but we're going to make it simple. You're going to see a few different lines, and each one has a number next to it. The first and most important one is liability. Liability coverage is the part of your insurance that is legally required in almost every state. It doesn't protect you. It protects everyone else from you. If you cause an accident, this is what pays for the other person's medical bills and car repairs. You'll probably see it written as 3 numbers separated by slashes, something like 50/100/50. This isn't a secret code. It's actually very simple. The first number, 50, stands for $50,000. That's the maximum amount your insurance will pay for a single person's bodily injury in an accident you cause. The second number, 100, is $100,000. That's the maximum total they'll pay for bodily injuries for everyone in the other car combined. The third number, 50 again, is $50,000. That's the maximum they'll pay for property damage, which usually means the other person's car. But it could also be a fence, a telephone pole, or a storefront you might have hit. Now, here is the biggest diagnostic test of all. Look at your liability numbers. Are they low? I'm talking about state minimums. In some states, that's as low as 25/50/25, or even 15/30/10. If you see numbers like these on your policy, you have just found red flag number 2, and it is a massive one. Having state minimum coverage is like showing up to a gunfight with a water pistol. A single, moderately serious accident in 2024 can blast through those limits in a nanosecond. One trip to the emergency room, one surgery, one totaled new car, and suddenly that $25,000 or $50,000 limit is gone. And guess who's on the hook for the rest? You are. They can go after your savings, your investments, even your future wages. Can financially ruin you. You might be thinking, but I want cheap insurance, isn't this the cheapest? In the short term, yes. But the crazy part is doubling or even tripling your liability coverage often costs just a few dollars more per month. The difference between financially reckless coverage and solid protection might be the price of a couple of coffees. If your liability limits are at the state minimum, you are not just a candidate for savings. You are a candidate for a smarter policy that could save your entire financial future. Okay, moving on. Look for 2 other words under your coverages: collision and comprehensive. People often lump these together and call it full coverage, but that's not a real insurance term. They are 2 separate things. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with another object, whether it's another car, a tree, or a guardrail. It's for when the accident is your fault. Comprehensive is for almost everything else. Think of it as the acts of God or weird stuff coverage. A tree branch falls on your car during a storm. A rock cracks your windshield on the highway, your car gets stolen, you hit a deer. That's all comprehensive. Now here's the diagnostic. Do you have these coverages? If your car is financed with a loan or you're leasing it, your lender almost certainly requires you to have both. You don't have a choice. But if you own your car outright, if the title is in your name free and clear, then this is your decision. And this brings us to red flag number 3. Look at your car. Is it an older car? Is it worth maybe $3,000, $4,000, $5,000? You can get a quick estimate on a site like Kelley Blue Book. Now look at your declaration page and see how much you're paying per year for collision and comprehensive coverage. It's usually broken down for you. Are you paying $600 a year to protect a car that's only worth $4,000? At some point, the math just doesn't make sense. You could be self-insuring. That means you take the money you would have spent on those coverages and stick it in a savings account. If you get into an accident, you use that money to fix it or buy a new beater. If you don't, the money is yours to keep. If you are paying for collision and comprehensive on an old, low-value car you own outright, you are very likely throwing money away every single month. But the story doesn't end there. For those of you who do need collision and comprehensive, look for the next column over. You'll see the word deductible. A deductible is the amount you have to pay out of your own pocket for a claim before your insurance company pays a single penny. It's your share of the cost. So, if you have a $500 deductible and you have a claim that costs $3,000 to fix, you pay the first $500, and the insurance company pays the remaining $2,500. Here is red flag number 4, and it's one of the easiest ways to save money, period. What is your deductible amount? Is it $250? Is it $500? Here's the secret. The lower your deductible, the higher your premium. It makes sense, right? If you're only willing to risk $250 out of pocket, the insurance company is taking on more risk, so they charge you more. One of the fastest ways to lower your monthly bill is to raise your deductible. Ask yourself this honest question. Do you have $1,000 in an emergency fund? If the answer is yes, then having a $500 deductible might be a waste of money. The premium savings you get by switching from a $500 to a $1,000 deductible can be significant, often 15 to 30% on that portion of your premium. Over a year or several years, that adds up to a huge amount of cash that stays in your pocket. If you have a low deductible and a healthy emergency fund, you are practically volunteering to overpay your insurance company. Finally, let's look at the bottom of the coverages section. This is the land of add-ons and extras. You'll see things like rental reimbursement, roadside assistance, uninsured or underinsured motorist coverage. Let's quickly diagnose these for red flag number 5. Uninsured and underinsured motorist coverage is actually really important. It protects you if you get hit by someone who has no insurance or who has those cheap state minimum policies we talked about. It pays for your medical bills and lost wages. In many states, it's optional, but given how many people drive uninsured, it's a smart buy. So we'll leave that one alone for now. But what about the others? Rental reimbursement. Are you paying $5 or $10 a month for that? Do you have a second car at home? Could you work from home for a week? Does your spouse have a car you could borrow? Are you paying for a service you might not even need? And roadside assistance. This one is the classic double dip. Many people pay their insurance company for this service when they already get it for free. Does your car's manufacturer provide it? Most new cars come with it for several years. Do you have a AAA membership? Do you have a premium credit card? Many of them, like the Amex Platinum or Chase Sapphire Reserve, include this as a perk. You could be paying for the same service 2 or even 3 times over. Add up the cost of these little extras. They seem small, but they are pure profit for the insurance company and a slow drain on your wallet. So let's review our diagnostic. Did you find any red flags? An old address or the wrong car model? Rock bottom liability limits that are putting your entire future at risk? Are you paying for full coverage on a car that's barely worth a few $1,000s? Is your deductible a super low $250 or $500 when you have cash in the bank? Are you paying for add-ons you already get for free somewhere else? If you looked at your declaration page and nodded your head yes to even one of these questions, then I have good news for you. You have just officially confirmed that you are a prime candidate for saving a serious amount of money on your car insurance. You've found the clues on the treasure map. But identifying the problem is only step 1. The next question is, why are your rates what they are? It's not random. Insurance companies use a secret, complex algorithm to decide what you pay, and it has way more to do with your personal data than your driving record. In the next part, we're going to pull back the curtain on the 5 biggest factors that are secretly inflating your insurance bill, and how you can start to take back control of them, starting with one surprising number that has nothing to do with your car. That number is your credit score. Yes, you heard that right. The 3-digit number that banks use to decide if you're worthy of a loan is one of the most powerful levers an insurance company uses to set your price. And right now you might be thinking, wait a minute, what does my ability to pay my credit card bill on time have to do with my ability to merge onto a highway safely? And that is the exact right question to ask. The answer is both infuriatingly simple and incredibly complex. Insurance companies aren't trying to figure out if you're a good driver. They're trying to figure out if you're a good risk. They are in the business of prediction. And over decades, by analyzing billions of data points from millions of customers, they found a strange but powerful correlation. People with lower credit scores, on average, file more claims. Not necessarily more accident claims, but more claims in general. It could be a cracked windshield, a fender bender in a parking lot, or a claim after a hailstorm. They're not saying you're a bad person. They're not even saying you're a bad driver. They're saying their giant spreadsheet of human behavior predicts that someone with your financial profile is statistically more likely to cost them money. It's a cold, hard calculation. For them, a person who is meticulous about their finances is often meticulous in other areas of their life, like maintaining their car and driving defensively. It's an algorithm, not a judgment. Now, the good news is that some states have caught on to how unfair this can feel, and they've banned or limited the use of credit scores in setting insurance rates. But for the vast majority of the country, your credit score is a silent passenger in your car, either quietly saving you money or secretly costing you a fortune. This is factor number 1. The ghost in the machine, your credit-based insurance score. The second biggest factor is the one you probably did think of, but maybe not in the right way. It's your car itself, the make, model, and year of the vehicle you drive. But it goes so much deeper than just sports cars cost more. Think of your car as your character in a video game. Every single attribute matters. First, there's the sticker price and repair cost. A bumper repair on a 10-year-old Honda Civic might be a few $100s. The same exact fender bender in a brand new Mercedes, with its embedded sensors and specialized paint, could be $5,000. The insurance company knows this. They have a database of every part for every car, and they know what it will cost to fix it. So, a car that's cheaper to repair is always cheaper to insure. Second, there's the safety rating. You'd think a safer car would be cheaper to insure, right? Yes and no. A car with incredible safety features that protect you is fantastic. But it's a double-edged sword. Those crumple zones, the dozen airbags, the pedestrian detection systems, they do a great job of saving lives, but they also make the car incredibly expensive to fix after an accident. So while your medical payment coverage might go down, your collision coverage costs could go up. And third, there's a factor you have absolutely no control over. It's popularity with thieves. Every year, a list comes out of the most stolen vehicles in America. And if your car is on that list, and it's often common popular sedans, not just high-end sports cars, your comprehensive coverage, the part that covers theft, is going to be higher. Period. You could live in the safest town in the country, but if you drive a car that's a magnet for thieves elsewhere, you pay the price. So factor number 2 is your vehicle. The price of a personality. Factor number 3 is perhaps the most controversial of all, because it judges you not by who you are or what you drive, but by where you live. I'm talking about your zip code. You could be the world's greatest driver with a perfect record and a clunker of a car. But if you move one street over into a different zip code, your insurance rate could jump by 30, 40, even 50% overnight. Feels personal, but again, it's purely statistical. Insurance companies are playing a game of averages. They look at your little 5-digit corner of the world and ask, how many claims happen here? Is this a dense urban area with a ton of traffic, stop-and-go accidents, and street parking where sideswipes are common? Or is it a sleepy rural area where the biggest risk is hitting a deer? They look at crime rates. More car break-ins and thefts in your zip code mean higher rates for everyone. They even look at the weather. If you live in a part of the country that gets a lot of hail or floods or hurricanes, your rate will be higher because the risk of a weather-related act of God claim is baked into your price. They even look at the rate of insurance fraud and the number of uninsured drivers in your area. If your neighbors are more likely to file bogus claims or drive without insurance, the company passes that cost along to the honest, insured drivers. You are paying for the statistical sins of your neighbors. It's a lottery you never signed up for, and it's why two people with identical cars and driving records can have wildly different bills, just because they live on opposite sides of the same town. This is factor number 3, the zip code lottery. Now for the one you knew was coming, your driving record. This is the most obvious and, frankly, the most fair of all the factors. It's the one part of the equation that is almost entirely within your control. But like everything with insurance, the devil is in the details. Your record isn't just a simple good or bad. It's a complex tapestry of data points that tell a story about you as a driver. First, there are the major violations. Things like a DUI, a reckless driving charge, or causing an accident that injures someone. These are the red flags, the nuclear bombs on your record. A single one of these can cause your rates to double or triple overnight, and can keep them high for 5, 7, or even 10 years. In some cases, an insurer might drop you altogether, forcing you into a high-risk pool that costs an astronomical amount. But it's the minor stuff that trips most people up. That one speeding ticket you got 3 years ago? It's still there. That rolling stop that a cop happened to see? It's on the books. Each of these little infractions adds points to your license. The more points you have, the higher your risk profile, and the higher your premium. Most people think a ticket is a one-time cost, you pay the fine and you move on. But that's wrong. A single speeding ticket can raise your insurance rates for 3 to 5 years. Do the math. A $200 ticket can end up costing you over $1,000 in increased premiums over time. It's the financial gift that keeps on giving. This is factor number 4. The ghost of tickets passed. Finally, we arrive at the 5th and final factor, and this one is the ultimate paradox. It's the one factor that you have 100% direct control over, yet it's the one that confuses people the most. It's your coverage choices, the very product you are buying. People get this wrong in 2 disastrous ways. They either buy way too little or they buy way too much. On one hand, you have people who just want the cheapest possible price, so they buy the absolute state minimum liability coverage. They see a low number and think they've won. But what they don't realize is that state minimums are often terrifyingly low. They might only cover $25,000 in property damage. What happens if you skid on some ice and hit a $60,000 Tesla? You are personally on the hook for the remaining $35,000. They could sue you, garnish your wages, and ruin you financially, all because you tried to save $15 a month. On the other hand, you have people who are paying for coverage they absolutely do not need. The classic example is keeping full collision and comprehensive coverage on a 15-year-old car that's only worth $2,000. They're paying, say, $600 a year for a policy that, after the $1,000 deductible, would only pay out a maximum of $1,000. They are literally paying $600 to protect $1,000. It makes no sense. Choosing the right coverage is a delicate balancing act between protecting your assets and not wasting your money. It's the final piece of the puzzle, and getting it wrong is like intentionally overpaying. This is factor number 5, the self-inflicted wound. So there they are. The 5 horsemen of your insurance premium: your credit score, your car, your zip code, your driving record, and your own coverage choices. Each one is a lever that the insurance company can pull to move your price up or down. And for most people, these levers are invisible, working in the background, costing them money they don't even realize they're spending. But now you can see them. And the first step to taking control is knowing what you're up against. In our next part, we're going to stop diagnosing the problem and start attacking it. We'll begin with that ghost in the machine, your credit score. And I'll give you a simple 3-step action plan to start improving it for the specific purpose of lowering your car insurance. Alright, let's get right into it. The 3-step action plan. Step 1 is the easiest, but it's the one most people skip because it feels like looking under the bed for monsters. You have to pull your credit report. Not just your score, but the full report from all 3 major bureaus: Equifax, Experian, and TransUnion. Now I know what you're thinking. Won't checking my credit hurt my score? That is a myth. That's a piece of financial folklore designed to keep you in the dark. When a lender checks your credit, it's a hard inquiry, and it can ding your score a few points. But when you check your own credit, it's a soft inquiry. You can check it every single day, and it will not affect your score 1 single point. It's like looking in the mirror. Looking doesn't change your face. So where do you go? You don't go to some random website you saw in a pop-up ad that promises you a free score, but asks for your credit card. You go to one place and one place only: annualcreditreport.com. This is the official, federally mandated site. It's the only one that is legally required to give you your full, detailed reports from all 3 bureaus for free once per year. This isn't a sales pitch. It's a public service. Go there, fill out the info, and download your reports. This is your battle map. You cannot win a war without a map of the territory. Let me tell you a quick story about a guy named Mark. Mark was a responsible guy. Paid his bills, had a decent job, but his insurance quotes were coming back brutally high. He couldn't figure it out. He finally pulled his full report and started digging. And there it was. A single medical bill for $75 from a clinic he visited 4 years ago. The bill had been sent to an old address, he never saw it, and it went to collections. That one tiny, forgotten $75 bill was like an anchor chained to his credit score, dragging it down into the mud. For 4 years, that little zombie account was telling every insurer that Mark was a credit risk. He paid the bill, disputed the collection with the credit bureaus, and within 60 days it was gone. His next insurance quote was $42 cheaper per month. That's over $500 a year, all because of a single $75 mistake he didn't even know he had made. That's the power of step 1. You have to know what the enemy is before you can fight it. This brings us directly to step 2, the sniper approach. Once you have your reports, you're not looking for a general sense of your financial health. You are a sniper. You are hunting for errors, and you will be shocked at what you find. A 2021 study by Consumer Reports found that more than a third of Americans found at least one error on their credit report. 1/3. That could be you. You're looking for misspelled names, wrong addresses, accounts that aren't yours, a closed account that's still listed as open, or the most common killer: a late payment reported on an account that you have never, ever paid late. When you find one, you don't just get angry. You act. Each of the 3 credit bureau websites has a very clear, easy-to-find dispute button. You click it. You'll be taken to a form where you simply state what's wrong. You don't need to be a lawyer. You just need to be clear. You say, "This account number 12345 from XYZ company is not mine." Or, "This account was paid in full on January 15, 2023, but is still showing a balance." Or, "This account is marked as a 30-day late payment for March, but I have a bank statement showing the payment was made on time." Then you upload your proof. A bank statement, a cancellation letter, a receipt. Anything. You are the prosecutor in the court of your own credit, and you are presenting the evidence. The bureaus are legally obligated to investigate your dispute, usually within 30 to 45 days. They contact the company that reported the information and ask them to prove it's correct. And here's the secret. A lot of the time, the original creditor can't be bothered, or they've lost the paperwork, or the debt has been sold to a collection agency that has sloppy records. If they can't prove it, they have to remove it. It's the law. This single step, disputing errors, is the fastest, most powerful way to surgically improve your credit score without changing a single spending habit. It's just cleaning up the mess that other people made on your file. Now for step 3, and this is where we go from defense to offense. We're building the good habit engine. This is about automating your success so you don't even have to think about it. 2 things make up 65% of your FICO score. Not 10 things, not 5 things. 2. Your payment history, which is 35%, and your credit utilization, which is 30%. We're going to fix both right now. First, payment history, the single most important factor. The rule is brutally simple. Never ever be late on a payment. A single 30-day late payment can drop your score by over 100 points and stay on your report for 7 years. It is a nuclear bomb to your financial life. So how do we prevent it? We take human error out of the equation. Tonight, or as soon as you finish this video, I want you to log into every single one of your credit card accounts, your car loan, your student loan, your personal loan, everything, and turn on autopay. I don't care if you just set it for the minimum payment. Just turn it on. This is your safety net. This is your financial force field. You can always go in and pay more manually before the due date, but the autopay function guarantees that you will never ever be hit with that score-killing late payment just because you got busy or went on vacation or the bill got lost in the mail. You are automating perfection. Second, credit utilization. This sounds complicated, but it's dead simple. It's the percentage of your available credit that you are currently using. If you have one credit card with a $10,000 limit and you have a $3,000 balance, your utilization is 30%. This is the second biggest factor in your score. Insurers and lenders see high utilization as a sign of financial distress. They think you're living on the edge, maxing out your cards just to get by. The magic number is 30%. You want to keep your total utilization below that. But if you really want to supercharge your score, you keep it below 10%. So how do you do that, especially if you use your cards for everything? I'll give you 2 powerful hacks. Hack number 1 is the mid-cycle payment. Most people wait for their statement to come out, see the balance, and then pay it. But the credit card company usually reports your balance to the bureaus on your statement closing date. So if you spent $2,000 that month, they report that $2,000 balance, even if you plan to pay it off in full a week later. The bureaus just see a high balance. The hack is to log into your credit card account 1 week before your statement is due to close and make a large payment then. This way, when the company reports your balance, it's already low. As far as the credit bureaus are concerned, you barely used your card that month. Your utilization plummets and your score soars. Hack number 2 is even easier. For any credit cards you've had for a year or more and have a good history with, call the number on the back of the card and ask for a credit limit increase. Just say, "Hi, I've been a customer for a few years, always pay on time, and I'd like to request a credit limit increase." That's it. Let's say you have that $10,000 limit with a $3,000 balance. That's 30% utilization. If they double your limit to $20,000, your $3,000 balance instantly becomes only 15% utilization. Your score goes up and you didn't have to pay off a single penny. You just changed the denominator in the equation. It costs you nothing and takes 5 minutes. So let's recap the plan. 1. Go to annualcreditreport.com, pull your real reports and face the monster. 2. Go on the hunt for errors and dispute every single one you find online. 3. Automate your success by turning on autopay for every account and using the mid-cycle payment and credit limit increase hacks to keep your utilization ridiculously low. This isn't just busy work. This is a direct assault on high insurance premiums. Every point your credit score goes up is like a discount coupon you can hand to your insurer. Now that we've tamed the ghost in the machine, we're going to move on to something you can control even more directly: the car you drive. You might think a safer car always means cheaper insurance, but the truth is far more complicated and far more expensive if you get it wrong. In the next part, I'll reveal the hidden insurance trap of certain car models and how to pick a vehicle that insurers will actually reward you for driving. You see, when you're shopping for a car, you're looking at the sticker price, the gas mileage, the color. But insurance companies, they're looking at something completely different. They're looking at your car's secret identity, its hidden financial DNA. And this is where millions of drivers fall into a trap they never even see coming. They buy the car they love, only to discover it's a financial landmine when the first insurance bill arrives. Let's start with the biggest factor, the one that's almost invisible to the average buyer: the cost of repair. You might assume that 2 sedans, both priced around $30,000, would cost about the same to insure. That assumption could cost you thousands. Imagine you're choosing between, say, a popular American-made SUV and a stylish German-engineered one. On the surface, they seem comparable. But a minor fender bender in the American SUV might require a new bumper cover and a sensor, costing around $900 to fix. That same fender bender in the German SUV could be a $3,000 nightmare. Why? Because its headlight assembly isn't just a bulb and a piece of plastic. It's an advanced matrix LED unit with integrated sensors and self-leveling motors, and it has to be replaced as a single sealed component. The insurance company knows this. They have databases overflowing with millions of claims, detailing the cost of every single part and the labor hours required for every conceivable repair on every model. They know that a side mirror on a Toyota Camry might be $300 to replace, while the side mirror on a luxury pickup truck, with its integrated camera, blind spot monitor, and power folding mechanism, could be $1,500. They aren't insuring your $30,000 car. They're insuring the potential for a $10,000 repair bill from a parking lot mishap. This is the first layer of the trap. A car that's affordable to buy can be brutally expensive to fix, and therefore brutally expensive to insure. But it gets even trickier. Let's talk about safety ratings. This is what I call the great paradox of modern car insurance. For decades, the advice has been simple. Buy a safer car, get cheaper insurance. And that's still partially true. A car with a 5-star crash rating from the National Highway Traffic Safety Administration is less likely to result in a massive medical claim, and insurers like that. But the very technology that makes cars safer today has become a double-edged sword. Think about features like automatic emergency braking, lane keeping assist, and adaptive cruise control. These systems are incredible. They use a complex array of cameras and radar sensors, often mounted in the windshield or front grille, to prevent accidents. And they work. They are demonstrably reducing the number of collisions. Insurers should love this, right? Well, yes and no. They love that you're less likely to have an accident, but they are terrified of the repair bill when you do. That camera mounted behind your rearview mirror? It's not just a camera. It's a precisely calibrated instrument that has to be perfectly aligned to function correctly. If you get a simple crack in your windshield, you can't just have any glass shop pop in a new one for a couple $100 anymore. The new windshield has to be installed, and then the entire camera system has to be professionally recalibrated, a process that can cost anywhere from $500 to over $1,500. All for a tiny rock chip. A simple bumper scrape is no longer a simple scrape. It might mean replacing multiple ultrasonic parking sensors and recalibrating a forward-facing radar unit, turning a $500 cosmetic fix into a $4,000 electronic repair. So the paradox is this: your car is safer so you crash less often. But when you do crash, the claim is exponentially higher. For the insurance company, it's a high-stakes gamble. They have to price their policies to account for the possibility of that one enormous repair bill. So you, the owner of this incredibly safe, technologically advanced car, are left wondering why your premium is so high. It's because you're driving a rolling supercomputer, and fixing it costs a fortune. Next up is a factor that has nothing to do with how you drive or how expensive your car is to fix. It's about how desirable your car is to criminals. I'm talking about theft rates. Every year, organizations like the Highway Loss Data Institute publish lists of the most stolen vehicles in America. And if your car is on that list, your insurance rate is going to be higher, period. It doesn't matter if you live in the safest neighborhood in the country, park in a locked garage, and have the best anti-theft system. You are being judged by the collective risk of your car model. Insurers know that certain models like Dodge Chargers and Challengers, or full-size trucks like the Ford F-150 and Chevy Silverado, are prime targets for thieves. More recently, certain Kia and Hyundai models became infamous for being incredibly easy to steal, leading to a massive spike in thefts. Insurance companies reacted instantly. Premiums for those models skyrocketed, and in some cities, some carriers refused to insure them at all. Why? Because the risk was just too high. They were paying out claim after claim for stolen vehicles. To stay in business, they had to pass that cost directly on to every single person who owned one of those cars. You're not just paying for your risk, you're paying a theft tax because of the car you chose to drive. Finally, there's the most judgmental factor of all: the driver profile. Insurance is a game of statistics and stereotypes, and insurers have decades of data on the type of person who buys a particular car. When you buy a Subaru WRX, a Ford Mustang, or a souped-up Honda Civic, you're not just buying a car. In the eyes of an insurer, you're joining a club of drivers who, statistically speaking, drive faster, get more speeding tickets, and are involved in more at-fault accidents than the general population. They know that the person buying a 300 horsepower sports sedan is probably not planning to drive it like a minivan. You might be the most responsible Mustang driver on the planet, but you are paying a premium based on the collective driving habits of every other Mustang driver in the country. Conversely, if you buy a Toyota Sienna minivan or a Subaru Outback, you're joining a different club. A club whose members are statistically more likely to be parents, to drive cautiously, and to prioritize safety over speed. Their risk profile is lower, and so are their premiums. It feels unfair, but it's the cold, hard math of the insurance industry. They are pricing the risk associated not just with the car, but with the typical behavior of its owner. So how do you avoid this trap? How do you peek behind the curtain and see a car's hidden insurance costs before you sign on the dotted line? It's actually shockingly simple, and it's the single most important piece of financial advice I can give anyone buying a car. Before you ever step foot in a dealership, you need to test drive the insurance. Here's the plan. Narrow your car search down to 2 or 3 specific models you're serious about. Go onto a dealership's website, or a site like AutoTrader, and find listings for the exact year and trim level you want. Copy the vehicle identification number, the VIN, for each car. Now go to the websites of a few major insurance companies and get a real official quote for each vehicle, using its specific VIN. The results will blow your mind. You might find that car A, which has the same sticker price as car B, costs $700 more per year to insure. Over a 5-year loan, that's a $3,500 difference. That's a vacation. That's a significant chunk of your emergency fund. This 15-minute exercise of quoting the VINs before you buy is the only way to uncover the true cost of ownership. You're letting the insurance companies tell you their secrets. You're exposing the hidden traps of high repair costs, theft rates, and driver profiles before you've spent a single dime. Picking the right car is one of the biggest levers you can pull to slash your insurance bill. But it's only half the battle. The other half is navigating the confusing maze of coverage options on the policy itself. Do you really need comprehensive? What exactly is collision? And what's the one type of coverage that almost everyone undervalues, but could literally save you from financial ruin after a serious accident? We'll break down that policy line by line in the next section. Alright, let's pull back the curtain on that piece of paper you get in the mail, the one that makes your eyes glaze over. Your insurance declaration page. It looks like a bunch of legal jargon and random numbers, but think of it less like a contract and more like a blueprint for your financial fortress. Each line item is a different wall, a different type of protection. And if one of those walls is missing or too weak, the whole fortress can come crumbling down after one bad day. So let's start with the absolute foundation, the one part of car insurance that isn't optional. This is your liability coverage. The word liability is just a fancy way of saying responsibility. This coverage isn't for you at all. It's for the other person. It pays for the damage you cause to other people and their property if an accident is your fault. This is what the government cares about. They want to make sure that if you mess up, you have a way to pay for it without bankrupting yourself and leaving your victim with a mountain of bills. Liability is split into 2 key parts. First, you have bodily injury liability. If you hit someone and they need to go to the hospital, this pays for their medical bills, their lost wages if they can't work, and even their pain and suffering. You'll see this listed on your policy as 2 numbers, like 25/50. That's not a fraction. The first number is the maximum amount, in thousands of dollars, that your insurance will pay for any one person's injuries. In this case, 25 means $25,000. The second number is the maximum amount they'll pay for the entire accident, no matter how many people are hurt. Here, 50 means $50,000. The second part of liability is property damage. This one's simple. It pays to repair or replace whatever you hit, whether it's another car, a mailbox, a storefront, you name it. This is the third number you see, so a policy might be listed as 25/50/25. That last 25 means your policy will pay up to $25,000 for property damage. Now here's the first major trap. Most people just buy the minimum amount of liability their state requires. And these state minimums are terrifyingly low. A 25/50/25 policy might be legal, but one moderately serious accident will blow past those limits so fast it'll make your head spin. Think about it. The average new car today costs over $48,000. If you total someone's brand new SUV with your $25,000 property damage limit, guess who's getting a letter from their lawyer for the remaining $23,000? You are. And what about medical bills? A single night in the hospital, an ambulance ride, a few scans, that can easily exceed $25,000. If you cause an accident that puts 2 people in the hospital, your $50,000 total limit could be gone in a day. Once your insurance pays out its maximum, the rest is on you. They can go after your savings, your investments, and even garnish your future wages for years. State minimum liability is not protection. It's a ticket to financial ruin. It's checking a legal box while leaving your entire future exposed. Okay, so liability covers the other guy. But what about your car? If you're at fault, liability does absolutely nothing for you. That's where collision coverage comes in. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object, usually another car, but also if you hit a pole, a guardrail, or a building. It doesn't matter who was at fault, because the accident collision fixes your car. If someone else hits you, their liability should pay, but if they are uninsured or it's a dispute, you can use your own collision coverage to get your car fixed immediately and let your insurance company chase the other guy for the money. When you buy collision, you have to choose a deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company starts paying. Common deductibles are $500 or $1,000. So, if you have a $500 deductible and you have an accident that causes $5,000 in damage to your car, you pay the first $500, and your insurer pays the remaining $4,500. The higher your deductible, the lower your monthly premium will be, because you're agreeing to take on more of the financial risk yourself. So, liability covers them, collision covers you in a crash. We're all set, right? Not quite. What happens if a tree branch falls on your car during a storm? What if you walk out of the grocery store to find your car has been stolen? What if a deer decides to use your front grille as a shortcut? None of those are a collision. For all of that bizarre, non-driving related stuff, you need comprehensive coverage. Think of comprehensive as the acts of God and jerks policy. It covers theft, vandalism, fire, hail, flooding, falling objects, and hitting an animal. Just like collision, it has a deductible that you choose. Many people see comprehensive as an optional add-on, and it is. But if you have a car loan or a lease, your lender will almost certainly require you to have both collision and comprehensive. They have a financial stake in your car, and they want to make sure their investment is protected no matter what happens to it. If your car is older and paid off, you might consider dropping these two coverages to save money, but if you couldn't afford to just go out and buy a new car tomorrow with cash, keeping them is probably a wise move. Now we get to it. The single most important, most undervalued, most misunderstood coverage on a policy. The one that protects you from the biggest X factor on the road, other drivers. It's called uninsured and underinsured motorist coverage. Let that sink in. Uninsured and underinsured. Statistics show that roughly 1 in every 8 drivers on the road in the United States has no car insurance at all. 1 in 8. They are driving illegally, and if they hit you and put you in the hospital, their non-existent insurance policy will pay you exactly $0. Your health insurance might cover some of your medical bills, but it won't pay for your lost wages, your long-term physical therapy, or the pain and suffering from an injury that could change your life. You'd have to sue the uninsured driver personally, and let's be honest, if they can't afford insurance, they almost certainly don't have any assets to give you. You can't get blood from a stone. You're left holding the bag. This is where uninsured motorist coverage becomes your literal financial savior. It steps in and acts like the insurance the other driver should have had. It pays for your medical bills and related expenses when you are hit by a driver with no insurance. But what about the underinsured part? This is just as dangerous. This is for when you get hit by someone who did follow the law and bought that cheap state minimum policy we talked about earlier. Let's say they have a $25,000 bodily injury limit, but your injuries are severe. You have surgeries, you're out of work for 6 months, and your total damages are $150,000. The at-fault driver's insurance will write you a check for their maximum, $25,000, and then wash their hands of the situation. You are still short $125,000. Where does that come from? It comes from your underinsured motorist coverage. It covers the gap between the other driver's pathetic limit and the actual cost of your suffering. Buying high limits on your own liability is about protecting your assets from others. Buying high limits on your uninsured and underinsured motorist coverage is about protecting your health and your family from the irresponsibility of others. It is shockingly inexpensive to add or increase, and skipping it is one of the biggest gambles you can possibly take. Finally, there's a smaller coverage you'll often see called medical payments, or MedPay. In some states it's called personal injury protection, or PIP. This is a simple, no-fault coverage. It pays for a set amount of medical expenses for you and anyone in your car, regardless of who caused the accident. It's designed to pay out quickly for things like ambulance rides, emergency room visits, or health insurance deductibles, without having to wait for a long fault investigation. It's a great safety net to have for immediate expenses. So there you have it. The core blueprint of your policy. Liability to protect others from you. Collision and comprehensive to protect your car. And uninsured/underinsured motorist coverage to protect you from others. Each piece is a critical wall in your fortress. But now you're facing the big question. Okay, I know I need more than the state minimum, but how much more? What are the actual numbers I should be asking for? How do I choose a deductible that saves me money without putting me at risk? Picking the right levels is the secret to being fully protected without overpaying by hundreds of dollars a year. And that's exactly where we're going next. Think of your car insurance policy not as a bill, but as a suit of armor. A custom-forged suit of financial armor designed to protect you, your family, and your future from a catastrophic blow. Right now, that policy might just look like a list of confusing words and numbers. But by the end of this, you're going to see it for what it is. A shield, a breastplate, and a helmet. And you're going to know exactly how to choose each piece to be invincible without paying a king's ransom. Let's start with the absolute foundation. The most important piece. This is your shield. Liability coverage. This is the one part of your insurance that is not for you. It's for everyone else. It's the coverage that pays for the damage you might cause to other people or their property if an accident is your fault. This is what's legally required in almost every state, and it's the reason you can't just drive without insurance. Your shield protects you from being sued into oblivion. When you look at a quote, you'll see liability written as a series of 3 numbers like 25/50/25. It looks like a secret code, but it's simple. The first number is the maximum amount, in thousands of dollars, your insurance will pay for a single person's injuries in an accident you cause. So 25 means $25,000. The second number is the maximum total amount they'll pay for all injuries combined in that one accident. So 50 means $50,000. The third number is the maximum they'll pay for property damage. That means the other person's car, or maybe the fence you hit, or the storefront you crashed into. In this case, 25 means $25,000. Now, here is the single most dangerous mistake that beginners make. They look at their state's minimum requirement, which might be that 25/50/25, and they say, great, I'll just get that. It's the cheapest. This is financial suicide. Let me paint a picture. You're in traffic, you glance at your phone for a split second, and you rear end the car in front of you. It's a brand new Tesla Model S. The repair bill for its bumper, its sensors, its trunk comes to $45,000. Your $25,000 property damage limit? It's gone in an instant. The other driver's insurance company pays the remaining $20,000, and then their lawyers come after you personally for that money. They can garnish your wages, put a lien on your house, and ruin your financial life for years. All because you tried to save $12 a month. And that's just property damage. What if the person in that car has a back injury? Medical bills can easily soar past $100,000. Your $25,000 limit for a single person's injury is a joke. It's not a shield, it's a paper plate. So what's the pro move? You increase your liability limits. The sweet spot for most people, the best bang for your buck protection, is 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries, and 100,000 for property damage. The surprising part is that quadrupling your protection from the state minimum doesn't quadruple your price. It might only cost you an extra 15 or 20 bucks a month. It is the single best investment you can make in your own financial security. Okay, so that's the shield. Protects you from what you do to others. Now let's talk about the armor that protects you and your car. This comes in 2 main pieces: collision and comprehensive. Collision coverage is your breastplate. It's straightforward. It pays to repair or replace your car if you collide with something. Another car, a telephone pole, a guardrail, a curb you didn't see. If you are at fault, this is the coverage that fixes your vehicle. Comprehensive coverage is your helmet. It protects you from all the weird, random, non-collision stuff that can happen. Think of it as act of God or act of chaos coverage. A tree branch falls on your car during a storm. A deer decides to play chicken with you on a country road. Your car gets hailed on and looks like a golf ball. Someone steals it. Someone vandalizes it. That's all comprehensive. If you have a loan on your car or you're leasing it, the bank will almost certainly require you to have both collision and comprehensive. They own part of the car, and they want to make sure their investment is protected. If you own your car outright, especially if it's an older car not worth much, you might consider dropping these. But for most people with a car they rely on, these are essential pieces of the armor. Now we get to the secret weapon for saving money, the deductible. Both collision and comprehensive coverage come with a deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your copay. If you have a $1,000 deductible, and you get into an accident that causes $5,000 of damage to your car, you pay the first $1,000. Your insurance company then pays the remaining $4,000. Here's the critical trade-off. A lower deductible means a higher monthly premium. A higher deductible means a lower monthly premium. Insurance companies are rewarding you for taking on more of the initial risk yourself. And this is where you can make a strategic move. Many people default to a low deductible like $250 or $500 because it feels safer. But they end up paying hundreds more per year for that feeling. The golden rule of deductibles is this. Choose the highest deductible you can comfortably afford to pay in cash, tomorrow, without it causing a major financial crisis. For most people with a decent emergency fund, this is $1,000. Look at the quotes. The difference in your annual premium between a $500 and a $1,000 deductible can be massive. Often a 15 to 30% savings on that portion of your policy. That could easily be $200 a year. Here's the hack. Take that $200 you're saving each year and put it into a separate high-yield savings account labeled car deductible. In just 2.5 years, you'll have saved the $500 difference. In 5 years, you'll have the full $1,000 deductible sitting there waiting. You've essentially used the insurance company's discount to fund your own risk. And every year after that is pure savings you're putting in your pocket. Finally, let's talk about two of the most overlooked, yet absolutely vital pieces of your armor. These are the magical enchantments that protect you from the irresponsibility of others. They are uninsured and underinsured motorist coverage. Let this sink in. The Insurance Research Council estimates that 1 in every 8 drivers on the road with you right now has no insurance. None. So what happens when one of them runs a red light and plows into you? And it's completely their fault? They have no liability shield to pay for your wrecked car or your hospital bills. You're just out of luck. You'd have to sue them personally, and if they can't afford insurance, they probably can't afford to pay you a $50,000 settlement. This is where uninsured motorist coverage saves you. It steps in and acts like the insurance the other driver should have had. It pays for your medical bills and, in some states, your car repairs. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their pathetic state minimum limits aren't enough to cover your costs. Getting this coverage is a non-negotiable. It's you insuring yourself against the worst-case scenario. And tied to that is medical payments coverage, or MedPay. In some states it's called personal injury protection, or PIP. This is like a small health insurance policy specifically for car accidents. It pays for your medical expenses and your passengers up to a certain limit, say $5,000 or $10,000, no matter who was at fault. The beauty of it is its speed. While the insurance companies are spending weeks or months investigating and arguing about who's to blame, MedPay pays your emergency room bills right away, so you don't have to worry about collectors. It's inexpensive and it's incredible peace of mind. Okay, we've built the perfect suit of armor. You know what every piece does? The liability shield to protect others. The collision and comprehensive plates to protect your car. The deductible that you've strategically set to save money. And the uninsured motorist and MedPay enchantments that protect you from the follies of the world. But what's the right size? How much is too much? And how much is not enough? We've talked about 100/300/100, but is that right for you, your car, and your life? Because getting this wrong is the #1 way people either go broke from an accident or waste thousands on coverage they'll never, ever use. And we're about to solve that. Let's start with the single most important rule in all of car insurance. If you remember nothing else from this entire guide, remember this. You should have enough liability insurance to protect your net worth. Write that down. Your liability coverage should, at a minimum, equal everything you own minus everything you owe. Why? Because in a serious at-fault accident, that's exactly what's on the line. When you get sued, lawyers don't just look at what's in your checking account. They look at everything. The equity in your home, your investment portfolio, your savings, your future earnings. Everything becomes a target. Your insurance policy is the shield that stands between a lawsuit and your entire financial life. If the shield is too small, everything you've worked for can be taken. So, how do you figure out your number? It's simpler than it sounds. Grab a piece of paper. On one side, list your assets. The approximate value of your home, your cars, the money in your savings and checking accounts, your 401k, your stocks, any other major valuables. On the other side, list your debts, your mortgage, your car loans, student loans, credit card debt. Subtract your debts from your assets. That number you're left with? That's your net worth. And that's the absolute minimum amount of liability coverage you should be carrying. Let's make this real. Imagine 3 different people. See which one sounds most like you. First, we have Sarah. She's 23, a recent college grad. She drives a 2012 Toyota Camry, she rents an apartment, has about $5,000 in savings, and a mountain of student loan debt. Her net worth is actually negative, so she should just get the state minimum, right? She has nothing to lose. Wrong. This is the most dangerous myth in car insurance. When a court awards a judgment against you that's higher than your insurance limits, they don't just take what you have now, they can take what you're going to have in the future. It's called wage garnishment. They can legally take a percentage of every single paycheck you earn, for years, even decades, until that debt is paid off. Imagine trying to build a life, save for a house, or start a family when 25% of your income vanishes before you ever see it. For Sarah, getting the bare minimum state coverage of say 25/50/25 is financial suicide. A single accident involving one moderately expensive car and a minor injury could blow past those limits instantly, shackling her with debt for the next 10 years. So what should she do? She needs to upgrade. Moving from the state minimum to something like 50/100/50 provides dramatically more protection. That means $50,000 for one person's injuries, $100,000 total for all injuries in an accident, and $50,000 for property damage. And here's the secret. That upgrade is surprisingly cheap. The jump from terrible coverage to decent coverage often costs less than a few cups of coffee a month. Because you're not a high-risk driver to the insurance company, you're just a person with low limits. Increasing those limits is one of the cheapest and most powerful financial moves a young person can make. Next, let's meet Mark and Jessica. They're in their mid-30s with 2 young kids. They own a home and have about $80,000 in equity. They have 2 paid-off cars, a Honda CR-V and a Ford Focus. They've been diligent savers and have about $70,000 in their retirement accounts and savings combined. Their net worth is around $150,000. They currently have that 100/300/100 coverage we talked about. Is that enough? It's getting close, but they're playing with fire. That $150,000 net worth is a juicy target for an attorney. A serious accident on the highway, one that involves a newer SUV with multiple passengers who all need medical care, could easily exceed their $300,000 bodily injury limit. If a court awards $400,000, where does that extra $100,000 come from? Comes from their house. Comes from their kids' college fund. Comes from their retirement savings. For Mark and Jessica, the 100/300/100 policy is the absolute floor. The smart move, the responsible parent move, is to upgrade to 250/500/100. That's $250,000 per person, $500,000 total for injuries, and $100,000 for property damage. This single move puts a massive shield around their home equity and their family's future. The cost difference between 100/300 and 250/500 is almost always negligible compared to the colossal leap in protection it provides. You're talking maybe $15 or $20 a month to add hundreds of thousands of dollars in security. There is no better return on investment for your family's financial safety. Finally, let's look at David. He's 52, a successful professional. He has a beautiful home that's nearly paid off, with over $400,000 in equity. His investment portfolio and 401k are worth another $500,000. He owns his cars outright. His net worth is pushing $1 million. David has the 250/500/100 policy. He feels pretty well covered. He is dangerously underinsured. David is what attorneys call the perfect target. He has significant, easily accessible assets. If he causes a multi-car pileup or an accident that results in a permanent disability for someone else, the lawsuit won't be for a couple $100,000. It will be for millions. His $500,000 coverage limit would be exhausted in a heartbeat. The rest would come directly from his life's work. His home, his retirement, everything he planned to pass on to his children. For someone like David, the answer isn't just to max out his auto insurance. The answer comes in 2 steps. First, yes, he must increase his auto liability to the maximum the carrier offers, typically 250/500 or sometimes 500/500. This is a prerequisite. But the real solution is the single most powerful and cost-effective tool in personal insurance: an umbrella policy. An umbrella policy is a separate insurance policy that sits on top of your auto and home insurance. It only kicks in after your primary policies have paid out their limits, and it provides an extra layer of liability protection, typically in increments of $1 million. And here is the mind-blowing part. A $1 million umbrella policy for someone like David often costs between $200 and $350 per year. That's not a month, that's for the entire year. For less than $1 a day, he can add $1 million force field around his assets. For anyone with a net worth over $300,000 to $500,000, an umbrella policy isn't a luxury. It's an absolute necessity. It's the cheapest peace of mind you can possibly buy. So look at your situation. Are you Sarah, Mark, and Jessica, or David? Calculate your net worth. If you have little to no assets, get as far away from the state minimum as you can afford. 50/100/50 is a great goal. Protect your future income. If you're a homeowner with growing savings, 100/300/100 is your starting point, but 250/500/100 is where you can actually sleep at night. And if you've built a substantial nest egg, you need to call your agent tomorrow, max out your auto limits, and buy an umbrella policy. Not doing so is like building a beautiful house and leaving the front door wide open. So now you're protected from bankrupting yourself if you cause an accident. Your assets are shielded. Your future wages are safe. But what happens to your car? What if it's totaled in that accident? Or stolen from your driveway? Or a tree branch crushes its roof during a storm? Most people think they know what full coverage is, but they're usually dead wrong, and it costs them thousands when they finally need to file a claim. Next, we're demystifying collision and comprehensive, and I'll show you the one simple trick to decide on the perfect deductible that can save you hundreds of dollars every single year. Alright, let's break down the two types of coverage that protect your car. This is what people are usually talking about when they say full coverage. First up is collision. The name is pretty self-explanatory. This is the coverage that pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, a telephone pole, or even a pothole that you didn't see. The key thing to remember about collision coverage is that it pays out regardless of who is at fault. If you accidentally back into a pole in a parking lot, collision covers your car's repairs. If someone else runs a red light and T-bones you, their liability insurance should cover your car. But if they are uninsured or the process is taking too long, you can use your own collision coverage to get your car fixed right away. Your insurance company will then go after the at-fault driver's insurance to get their money back, a process called subrogation. So, think of it this way: liability protects everyone else from you, collision protects you from, well, collisions. Now what about everything else? What about all the bad things that can happen to your car that don't involve an accident? That's where comprehensive coverage comes in. This is sometimes called other than collision coverage, and it's your shield against the random, unpredictable chaos of the world. Comprehensive covers damage to your car from things like theft, vandalism, fire, or natural disasters like a hailstorm, a flood, or a hurricane. Did a tree branch fall on your car during a windstorm? That's comprehensive. Did you hit a deer on a dark country road? Surprisingly, that's also comprehensive, not collision, because an animal is considered an unpredictable hazard, not a fixed object or another vehicle. Did someone steal your catalytic converter? Or smash your window to grab your gym bag? Comprehensive. It's the coverage for all the non-driving related misfortunes that can befall your vehicle. So now the big question: do you actually need both? If you have a loan or a lease on your car, the answer is simple. Yes, you have to. Your lender or leasing company requires it because technically they still own the car. They need to protect their investment, and that means you're required to carry both collision and comprehensive until the car is paid off. But what if you own your car outright? What if you're driving a 10-year-old Honda that's been paid off for years? This is where you can make a strategic decision that could save you a lot of money. The general rule of thumb financial experts use is the 10% rule. It works like this. Find out the actual cash value of your car. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Then, look at your insurance statement and see how much you're paying per year specifically for collision and comprehensive coverage. If that annual cost is more than 10% of your car's value, it might be time to consider dropping them. Let's use an example. Say your trusty 2012 Toyota Camry is worth about $4,000. You check your policy and realize you're paying $600 a year for collision and comprehensive. That's 15% of your car's total value. In this case, you're paying a significant amount to protect a relatively low-value asset. If you got into an accident and totaled the car, the most the insurance company would give you is $4,000 minus your deductible. You have to ask yourself, is it worth paying $600 every year for that level of protection? If you have a solid emergency fund and could afford to repair or replace the car out of pocket, dropping these coverages and self-insuring could be a smart financial move. You'd bank that $600 every year instead. However, if your car is still worth $20,000 and your collision and comprehensive coverage costs $800 a year, that's only 4% of the car's value. In that case, paying $800 to protect a $20,000 asset is almost certainly a wise investment. Now let's talk about the single most important lever you can pull to control the cost of these coverages: the deductible. This is the simple trick I promised. The deductible is the amount of money you have to pay out of pocket for a repair before your insurance coverage kicks in. It applies to both collision and comprehensive claims. Imagine you have a $500 deductible. You get into a fender bender, and the repair estimate is $3,000. You pay the first $500 to the body shop, and your insurance company pays the remaining $2,500. If the damage was only $400, you wouldn't even file a claim because the cost is less than your deductible. You just pay it yourself. This is where the magic happens. Insurance companies let you choose your deductible amount, typically ranging from $250 all the way up to $2,000 or more. And here is the fundamental trade-off. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium will be. Why? Because with a higher deductible, you are agreeing to take on more of the financial risk yourself. You're telling the insurance company, don't worry about the small stuff. I can handle a $1,000 or $1,500 hit. I only need you for the really big, catastrophic damage. The insurance company loves this. It means they'll have to pay out on fewer claims, which saves them money, and they pass a portion of those savings on to you in the form of lower premiums. So, how do you choose the perfect deductible? You don't just guess. You use math. Here is the simple two-step trick to figure it out. Step 1. When you're getting quotes, ask to see the price for a few different deductible levels. Specifically, get the annual premium for a $500 deductible and for a $1,000 deductible. Step 2. Do what I call the break-even calculation. Let's say your policy with a $500 deductible costs $1,800 per year, and the same policy with a $1,000 deductible costs $1,500 per year. By choosing the higher deductible, you save $300 every single year. Now ask yourself this critical question. How long would I have to go without an accident for my savings to cover the extra risk I'm taking on? In this case, your extra risk is $500. That's the difference between the two deductibles. Your annual savings are $300. So, you divide the extra risk by the annual savings. 500 divided by 300 is about 1.67. This means that if you go just 1 year and 8 months without a major claim, you will have already saved enough money to completely cover the higher out-of-pocket cost you'd face in an accident. Any year you go claim-free after that is pure profit in your pocket. Most financial advisors say that if your break-even point is under 4 years, raising your deductible is a fantastic financial decision. The odds are overwhelmingly in your favor that you will save more money in the long run. But there is one absolutely non-negotiable rule you must follow if you do this. You must have your deductible amount saved in an accessible emergency fund. Do not choose a $1,000 deductible if you don't have $1,000 sitting in a savings account. A low premium is worthless if you can't afford to actually use your insurance when you need it. The goal is to lower your fixed costs, your premiums, while being fully prepared for the potential variable cost of the deductible. By pairing a higher deductible with a dedicated emergency fund, you get the best of both worlds: lower monthly bills and complete peace of mind. So, to recap the process for your own car: first, determine its actual cash value. Second, if you own it outright, use the 10% rule to decide if keeping collision and comprehensive even makes sense. And third, for the coverages you do keep, run the break-even calculation on your deductible. Find the sweet spot where you're saving a significant amount on your premiums, and you're 100% comfortable with having that deductible amount ready to go in your emergency fund. This simple process can easily save you hundreds, if not thousands of dollars over the life of your car. Now that you've mastered the core coverages that protect your car and your wallet from others, there's one last layer of protection that most people ignore, but it's the one that can save you from financial ruin if the unthinkable happens. We're talking about underinsured and uninsured motorist protection, and I'll show you why getting the maximum amount is the single smartest and cheapest decision you can make. Here's a staggering and frankly terrifying statistic. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means on your average commute, you will pass dozens, maybe hundreds of drivers who have absolutely no ability to pay for the damage they might cause. And that doesn't even count the millions more who carry only the bare minimum liability coverage required by their state. A number so low it's practically useless in a serious accident. This is where your own insurance policy becomes your personal financial bodyguard. See, we all think our liability coverage is there to protect other people from us. But uninsured and underinsured motorist protection is the part of your policy that protects you from them. It is, without a doubt, the most important coverage you can buy, and it's shockingly inexpensive. Let's paint a picture. Meet David. He's a responsible guy. He works hard, pays his bills, and he followed all the advice we've talked about. He has a great insurance policy with 100/300/100 liability limits. One Tuesday afternoon, he stopped at a red light in BAM. He's rear-ended by a driver going 45 miles per hour. The crash is violent. David's car is totaled. He's rushed to the hospital with a severe back injury and a concussion. The police report is clear. The other driver is 100% at fault. David's initial thought through the haze of pain is relief. At least their insurance will cover this. But then the nightmare begins. The other driver has no insurance. Zero. He let his policy lapse 2 months ago. He has no assets, no savings. You can't get blood from a stone. So who pays for everything? Let's add it up. The ambulance ride and emergency room visit? $10,000. The MRI on his back? $4,000. The surgery to repair a herniated disc? $50,000. Then comes months of physical therapy, costing another $15,000. That's $79,000 in medical bills just to start. His health insurance helps, sure, but he has a $5,000 deductible, and then a 20% coinsurance up to a max out-of-pocket of $10,000. So David is on the hook for $10,000 right off the bat. Money he doesn't just have lying around. What about his car? It was worth $25,000. It's a twisted wreck now. The at-fault driver isn't paying for it. So David has to use his own collision coverage, which means he has to pay his $1,000 deductible. And the worst part? David is a contractor. His job is physical. The doctor says he can't work for at least 3 months while he recovers. That's 3 months of lost income. Let's call it $15,000 he won't be earning. So let's tally the damage from an accident that was not his fault. $10,000 in out-of-pocket medical costs. $1,000 for his collision deductible. $15,000 in lost wages. Total immediate financial hit, $26,000. And that's not even counting the pain, the suffering, the stress on his family, or the permanent impact of the injury. This is financial ruin. All because a stranger was irresponsible. But now let's rewind the clock. Let's say when David was setting up his policy, he made one crucial decision. He listened to this guide and he maxed out his uninsured motorist protection. He got a policy that matched his liability limits. $100,000 per person, $300,000 per accident. Here's what happens now. When David finds out the other driver is uninsured, he makes a call to his own insurance company and opens an uninsured motorist claim. His insurance company essentially steps into the shoes of the uninsured driver. They become the insurance the other guy should have had. His uninsured motorist bodily injury coverage, that $100,000 limit swoops in. It pays for his $10,000 out-of-pocket medical bills. It pays for his $15,000 in lost wages. It can even provide compensation for his pain and suffering. Suddenly, that $26,000 hole in his finances is gone. He can focus on healing, not on the threat of bankruptcy. And what about his car? If he had uninsured motorist property damage coverage, it could have paid for his totaled car without him having to pay his collision deductible. It's a separate but equally important part of the coverage. Now, what if the other driver wasn't uninsured but underinsured? Let's say they had the state minimum coverage in Florida, which is just $10,000 for property damage, and that's it for many policies. Your $25,000 car is totaled, and their policy only pays $10 grand. Your underinsured motorist coverage would step in to cover the remaining $15,000 gap. It fills in what the other person's pathetic policy lacks. So what does this financial life raft cost? This is the most incredible part. Adding or increasing your UM/UIM coverage is one of the cheapest things you can do. Why? Because your insurance company only has to pay out if the other driver is at fault. From their perspective, the odds are in their favor. It's a low-risk product for them, which means it's a low-cost, high-value product for you. We're often talking about a few dollars a month. The difference between having a measly $25,000 limit and a robust $250,000 limit might be the price of a couple of cups of coffee. You are protecting yourself from a $250,000 catastrophe for the cost of a Netflix subscription. There is no better return on investment in the entire world of insurance. So here is your non-negotiable action item. After watching this video, pull up your insurance policy. Find the section for uninsured/underinsured motorist bodily injury and property damage. If those numbers do not match your primary liability limits, you need to call your agent or go online and increase them. Today, do not wait. Get the maximum amount they will sell you. And with that, we've come to the end of our journey. We've pulled back the curtain on an industry that feels intentionally confusing. But you are now armed with the knowledge to fight back and win. Let's do a lightning round recap of the 10 most powerful lessons. 1. Loyalty is a myth. You must shop your car insurance with at least 3 to 5 different companies every 6 months. This is the single biggest money saver. 2. Understand liability limits. 100/300/100 is your new minimum standard to protect your assets and your future. 3. Set your deductibles strategically. A higher comprehensive deductible and a manageable collision deductible is the sweet spot for balancing premium savings and risk. 4. Discounts are not automatic. You must ask for every single one you might qualify for. Good student, defensive driving, professional organizations, anti-theft devices, paperless billing. Make a list and check every box. 5. Your credit score is a secret driver of your insurance rates. Protect and improve your credit, and you'll be rewarded with lower premiums. 6. Don't overpay for extras you don't need. Evaluate things like rental reimbursement and roadside assistance to see if they're truly worth the cost or if you have coverage elsewhere. 7. Embrace technology. Usage-based insurance programs like Snapshot or DriveWise can offer massive discounts for safe drivers. Give them a try for a policy term. 8. Bundle your policies. Combining your auto and home or renter's insurance with one company almost always unlocks a significant discount. 9. Know when to drop coverage on older cars. If your car's value is low, paying for collision and comprehensive might cost more than the car is even worth. Do the math. And 10. The rule we just covered. Max out your uninsured and underinsured motorist coverage. It is the cheapest, smartest way to protect yourself from financial ruin at the hands of an irresponsible driver. You are no longer a beginner. You are an informed consumer. You have the playbook. The power is now in your hands to stop overpaying and to start building a policy that truly protects you and your family without draining your bank account. The next time your renewal notice comes in the mail, you won't feel that sense of dread or confusion. You'll see an opportunity to apply what you've learned to make smart choices and to save hundreds, maybe even thousands of dollars a year. That's real money that you can put toward your goals. A vacation, a down payment, or simply peace of mind. Thank you for investing your time with me. Now go take control of your car insurance. Your future self will thank you for it.